Okay, so in this video, I'm going to show you what is transactions exposure. Transaction exposure is defined as a type of foreign exchange risk faced by companies that engage in international trade. So as long as you engage in international trade, so you are going to have receivable or payable that denominated in a foreign currency. So when you export, you receive payment, right? And then when you import, you have to make payment. So as long as you engage in international trade, and if your receivable and the payable are denominated in a foreign currency, then you are subject to this kind of risk, transactions exposure. So this exposure is short-term to medium-term in nature. Okay, so I'm going to show you one example. Okay, so how this exposure comes about. Okay, so yeah, so this is the example. So again, I'm using the same example as our case study. So Jim Logan and his UK distributor. So before they make any transactions, before Jim Logan export to UK, so they make agreement. They will sign agreements, and then through the agreements, we know that the payment will be in the UK pound. So that means the UK distributor will pay in foreign currency. Okay, so after the signing of the agreement, then Jim will export 100 units of product to UK. Okay, so the payment is not made today, it's not made immediately. This is not cash and carry. So the payment for the goods will be made in 3 months with 100 units of pound. So through the agreements, they agree to pay in pound. Okay, and then they agree to pay 100 units of pound for this 100 units of product. Okay, and then just assume that the current exchange rate is 1-to-1. 1 unit of pound equals 1 unit of US dollar. So with this exchange rate, with the current exchange rate, Jim Logan receive 100 units of US dollar. If the exchange rate remain unchanged in 3 months. So do you think possible if the exchange rate remain unchanged? So in the real world, impossible, because our exchange rate is not fixed over the time. Okay, so I just assume that what if the exchange rate remain the same in the 3 months? So Jim will receive 100 units of dollar after you convert pound to dollar, right? Not based on this exchange rate. Okay, so as I said, that in the real world, exchange rate is not fixed. So assume that the next day, the exchange rate changes and then remain constant at the new exchange rate for 3 months. So we see what happened. Okay, what happened to Jim Logan. Okay, so now the exchange rate is no longer 1-to-1. This is 2 units of pound equals 1 unit of dollar. So that means pound depreciate and the value of dollar appreciate, right? Because of previously you get 1 pound, but now you get 2 pounds. Then dollar appreciated, but pound depreciated. So with this exchange rate, what happened to the payment that to be received by Jim Logan in dollar? Is it still the same 100 dollar. So we look at this exchange rate. So in the foreign currency, Jim still receives 100 units of pound. But when Jim convert the pound into dollar, so how much Jim receive? Jim only receive 50 units of US dollar. So if you compare to the previous exchange rate, which is 1-to-1, so which one is better? So the previous one is better for Jim, but this one is not. So this is what I want to show you. This is called transactions exposure because of the changes in the exchange rate. So it will affect the cash flow and also the market value for Jim Logan. How about the cash flow for Jim Logan? The cash flow in terms of dollar reduced from $100 to become $50. Okay, yeah, so this is transactions exposure. So in the next video, I'm going to show you translations exposure. Okay, welcome back. So in this video, I'm going to show you what is translation exposure. Translation exposure, also called accounting exposure, arises because financial statements of foreign subsidiaries, which are stated in foreign currency, must be restated in the parent's reporting currency for the firms to prepare consolidated financial statements. And since exchange rate change over time, the translation of the subsidiary financial statement into a different currency is affected by exchange rate movement. So this, in preparing the consolidated financial statements, so it's not that straightforward because you need to convert foreign currency into the domestic currency, into the same currency. So therefore, this will be affected by exchange rate movement. And the exposure of the multinational corporations' consolidated financial statement to exchange rate fluctuation is known as translation exposure. So this is translation exposure. Okay, so the accounting process of translation involves converting this foreign subsidiary financial account into the domestic currency denominated statements. So this is example. Okay, so this is example. So assume that Jim Logan, so this company is a US based company, it's a multinational corporation, and then the company has 3 foreign subsidiaries in Japan, in Thailand, and also in the UK. And every subsidiary financial statements is normally measured in its local currency. Okay, so they will prepare, every subsidiary will prepare their own financial statement in local currency. In Japan, yen. In Thailand, Thai baht. In UK, they will prepare in pound sterling. So, to be consolidated, each subsidiary's financial statement must be translated into the currency of the multinational corporation parents. So, to be consolidated, all the financial statement which is denominated in foreign currency must be translated into the US dollar. Okay, why dollar? Because of this company is a US based company. Since exchange rate change over time, the translation of the subsidiary financial statement into the dollar is affected. by exchange rate. So because of the conversions, so the conversions is actually subject to the risk in exchange rate movement. Okay, so they prepare their own financial statement, and then for the consolidated purposes, so they must prepare the financial statement in the dollar. Okay, so you will notice actually if you look at the research paper or whatever, so you'll find that the more asset or liability the company has that are denominated in a foreign currency, the greater the translation risk. Okay, when a multinational companies have this kind of situations and then denominated in a foreign currency, then that means that they are going to face higher translation risk. So I'm going to show you an example. Okay, of course, this exposure is medium term to long term. Okay, so it's different with the transaction. Transaction is short term to medium term. Okay, I'm going to show you an example. So this example shows that these multinational corporations have domestic divisions in US. So this is actually is a US based company. Okay, so they also have a domestic divisions and also a foreign subsidiary. Okay, so based on the financial statements, domestic divisions experience net operating loss of $3,000, and then based on the financial statement of the foreign subsidiary, so the net operating profit is 3,000 units of foreign currency. Okay, and then assume that the current exchange rate is 1:1. One domestic currency equals one foreign currency. Okay. So with this, you'll find that after the consolidations of the financial statements, that means you have to convert the profit in foreign currency into the dollar when you prepare a consolidated financial statement. So you'll find that the foreign subsidiary profit, because of here is profit, exactly cancel out the domestic division's loss. Okay, so when we prepare a consolidated financial statement, this is going to happen. So even though domestic divisions experience a net operating loss, but after you take into account the profit from your foreign subsidiary, so the profit cancel out the loss. Okay, so what if now the current exchange rate is not 1:1, but is 1 unit of domestic equals 2 units of foreign currency? So what does it mean? Okay, so if you take into account this exchange rate, because of this exchange rate change, exchange rate is not fixed over time. So what will happen? Do you think the profit still can cancel out the loss when we prepare a consolidated financial statement? What do you think? After you take into account the current exchange rate, so you'll find that foreign subsidiaries profit is only worth not 3,000 here, worth $1,500, and therefore you'll find that you're unable to cancel out all the net operating loss that experienced by domestic divisions. Okay, so this is the difference. Can you see the difference? Okay, so because of exchange rate changes, so there's a difference when you prepare a consolidated financial statement. So you'll find that in this particular example, the profit is no longer able to cancel out the loss. Okay, so this is a risk. The risk, and this kind of risk is called translation exposure. Okay, so in the next sections, I'm going to show you economic exposure. Okay, so in this video, I'm going to show you what is economic exposure. So the value of a multinational corporation as well as its cash flow can be affected by exchange rate movements. If it executes transactions in foreign currency, receive revenue from foreign customer, or is subject to foreign competitions. So the sensitivity of the firm's cash flow to the unexpected change in exchange rate is referred to as economic exposure. Okay, and then this kind of exposure sometimes is called operating exposure, competitive exposure, and even strategy exposure. This type of exposure is long-term in nature, and then transactions exposure is a subset of economic exposure. Okay, so next I'm going to show you how are we going to measure the exposure. Okay, so we look at this table. So this table first look at the inflow, how exchange rate movement affect local currency inflow. Okay, so first of all, we look at these transactions, local sales, how exchange rate movement affect local sales. Even though we know that in local market, we are not state the price in foreign currency, but somehow for local sales will also be affected by exchange rate movement. So don't you think that because of local sales using domestic currency, they are not affected? They are affected by exchange rate movement. Okay, so we look at this. If local currency appreciates, what happened to local sales? So local sales in the firm's home currency are expected to decrease if the local currency appreciates. Because, you know why? Because the firm will face increases foreign competitions. Because of the foreign products become more cheaper as compared to the local product. So therefore, local customer will be able to obtain foreign substitute products cheaply with their strengthened currency. So this affects local sales because of local products are more expensive. Right now. Okay. So what happens if local currency depreciates? If local currency depreciates, so it will the customer will increase their purchase on the local sales because of foreign substitute products become more expensive with their weakened currency. Okay, so this is how exchange rate movement affect the local sales. and then it affects the inflow. So here the inflow, the local currency inflow decline. So here the inflow increase. Okay. Yeah. So now we look at export denominated in local currency. What do you think? If the local currency appreciates, do you think the inflow will increase or decline? Okay, so listen to my explanations. Cash flow from export denominated in the local currency will also likely be reduced if local currency appreciates, because foreign exporters will need more of their currency to pay for this product. Okay. So therefore, the demand for the export may decline. So therefore, the cash flow decline as well. Okay. So what happens if the local currency depreciate? If local currency depreciate, so this will help export. Okay, so the demand for export will increase, and this will increase the inflow of local currency. Okay, so what happens if export denominated in foreign currency? So for this case, all those foreign importers will not need more of their currency to pay for this product, but the amount of local currency to be received will likely be reduced as a result of appreciations in local currency. Yeah, so the local currency inflow will decline if local currency appreciates, because you receive less domestic currency. Okay, if local currency depreciates, so the cash inflow increase because of you receive more local currency if local currency depreciate. Okay, can you understand? Okay, now we move on to another transactions. Interest received from foreign investment. You make investment in foreign country, so you will receive interest. So what happens in this case if local currency appreciate? Are you going to receive more local currency or less local currency? Okay. So in this case, the cash inflow decline. Why? Because any interest or dividend received from foreign investment will also convert to a reduced amount if the local currency has strengthened. When you receive the currency, the foreign currency, so you will convert to domestic currency. When you convert to domestic currency, so the amount will reduce if local currency appreciate. However, if local currency depreciate, then you are going to get more local currency. So the inflow of local currency will increase. So remember, here we are talking about local currency. So every time when you receive a foreign currency, when you conduct any of the international transactions, so you must convert to local currency. And then by the time when you convert to local currency, then you are able to know whether you are going to have increase in the cash flow or decrease in the cash inflow. Okay, so now we are going to move on to another sections here. So here is talk about outflow. Outflow means when we buy foreign products, or we have international transaction, or maybe we pay interest payment. Okay, so from our borrowings, so we have to get involved in this kind of outflow. Okay, so we want to see how exchange rate movement affect the outflow. Okay, first we look at imported supplies denominated in local currency. So what happens if local currency appreciates? With regards to the cash outflow, the cost of imported suppliers denominated in the local currency will not be directly affected by changes in exchange rate. Because of the imported suppliers denominated in local currency, you see, in local currency. So therefore, any changes in exchange rate movement will not affect the cost of import. So the cost of import is measured in local currency. So it's not affected because of they are in the local currency. However, if the imported supplies denominated in foreign currency, so what happened? So you'll find that if local currency appreciate, the cost of imported goods and services denominated in the foreign currency will be reduced. If the local currency appreciates, so the cost of imports will reduce. Okay. However, if local currency depreciate, so that means you need more local currency to purchase the same goods and services. Okay, because you need more local currency, so you are going to experience more outflow of local currency because you need more local currency to buy the same goods and services. Okay, so the local currency outflow will increase if local currency depreciate. And then interest owned on foreign funds borrow. So you borrow a foreign funds, you make a borrowing, you need to make interest payment. Okay, so what happens if local currency appreciate? So any interest to be paid on financing in foreign currency will be reduced if the local currency appreciate. Okay, because the strengthened local currency will be exchanged for the foreign currency to make the interest payment. Okay, so therefore you'll find that the outflow, the local currency outflow will decline. However, if local currency depreciate, so this is not good for you because of you need to prepare more local currency to make the interest payment. Because of the interest payment is denominated in foreign currency. So therefore, if the currency depreciate, you need more local currency to make the payment. So therefore, your local currency outflow increase, which is no good for you. Okay? Yeah. So throughout these two tables, I've shown you how exchange rate movement affect local currency inflow as well as outflow. So in the next sections, so I'm going to teach you how to measure exposure. Okay, so in this video, I will show you what is economic exposure, and I will show you how to measure economic exposure using sensitivity analysis as well as regressions analysis. Okay, so since multinational corporations are affected by economic exposure, they should assess the potential degree of exposure that exists, and then determine whether to insulate themselves against this kind of exposure. So one method of measuring the exposure is to separately consider how sales and expenses are affected by various exchange rate scenarios. And this method is called sensitivity analysis. Okay, I'm going to show you a few examples on how we can conduct these types of analysis. Okay, so this table shows a very simple sales, expenses, and the cash flow for a multinational corporations. And this multinational corporation is based in the US, and the company has a subsidiary, a foreign subsidiary in Canada. And then if you look at the table, so you'll find that actually the sales expenses as well as their cash flow are denominated in dollar. And then for the case of their business in Canada, so sales expenses and the cash flow are denominated in Canadian dollar. And the estimate of the cash flow are over here, are estimated, are shown in this table as well, and separated by country. Okay. And then if you look at this table, this one is more specific on the component of the sales expenses. Okay, and then here we assume that the multinational corporations expect 3 possible exchange rates for the Canadian dollar over the period of concern. So they assume 3 scenarios. So this is one of the scenario. What if the exchange rate 1 Canadian dollar equal 0.7 dollar. So this will be the second scenario, and this is the third scenario. So these scenarios are separately analyzed in the second, third, and fourth columns. Okay, so the figure here actually is adjusted according to the exchange rate of different scenarios. Okay, so from this table you are able to see the effect of exchange rate on revenues and costs. And this information are now reported in this table. So what can we get from this table? A general conclusion from this example is that firms with more in foreign costs than in foreign revenue will be negatively affected by a stronger foreign currency. Okay, so and then please note that this example is just based on a one period time horizon. There's no time series. There's only one period time horizon only. So if firms have developed forecasts of sales, expenses, and exchange rate for several periods ahead, they can actually assess their economic exposure over time. Now, if there is a time series, let's say the firms make a forecast for several periods ahead, then they are able to assess how exchange rate movement in future that will affect their future cash flow. Okay, so their economic exposure will be affected by any change in operating characteristic over the time. So if they manage to make a forecast, for several period ahead. Okay, yeah. So this is we call it as a scenario analysis. Why? Because of we produce different scenario for our sales, expenses, and also the cash flow. So this will be one of the method that we can use to measure economic exposure. Okay, yeah. So in the next video, I'm going to show you how to measure economic exposure by the use of regressions analysis. Alright, so in this video, I will show you how to measure economic exposure using regressions analysis. Okay, so of the economic exposure to currency movements can also be assessed by applying regression analysis to historical cash flow. This is a historical cash flow and exchange rate data. Okay, so we can apply a regressions using these two set of data, cash flow as well as exchange rate. Okay, and then the regression coefficients A1. This is the regression coefficient that we are interested to know. Estimated by regression analysis indicate the sensitivity of the cash flow to the movement in the currency. Okay, so if the coefficient is positive and significant, this implies that a positive change in the currency values has a positive effect on the firm's cash flow. However, if the coefficients, the A1, is negative and significant, this implies a negative relationship between the change in the currency value and the firm's cash flow. So if the firm anticipate no major adjustment in his operating structure, so based on the regression analysis, so it will expect the sensitivity detected from regressions to be somewhat similar in the future. Yeah, so if there's no any major adjustment in his operating structure, so we can rely on the cash flow, these two set of data, cash flow and exchange rate, to make the prediction, to measure the economic exposure. Okay, so how to measure? So we are actually rely on this coefficient A1, because of A1 indicate the sensitivity of cash flow to currency movements. Okay, yeah. So these are the possible way that we can measure economic exposure. So here I show you the sensitivity analysis, and then I also show you another method which is using regression analysis. Okay, so in the next video I will show you how to manage the risk. Okay, in this video I will show you how to manage exchange rate exposure. So recall from the previous sections of videos that a multinational corporation is exposed to exchange rate fluctuation in three ways, which is transaction exposure, economic exposure, and translation exposure. So this video will focus on the management of exchange rate risk exposure, and by managing the risk exposure, financial managers may be able to increase the cash flow and to enhance the value of their multinational corporations. Okay, so these are the common hedging strategies that we can use to minimize, to reduce the risk of exchange rate exposure. Okay, so I'm going to show you strategy by strategy. So first is the forward and the futures hedge. Okay, and then our strategy actually can be divided into two. So it depends on what kind of situation that we face. If you need to make a payment, let's say you purchase goods and services, you import goods and services from a foreign country, so you want to make payment, okay? And then when you want to make a payment, and at the same time, based on your forecast, you expect a depreciation in domestic currency. So your domestic currency here is the dollar depreciate. So when your dollar depreciate, so what happened in your payment? So you need more domestic currency, you need more dollars to make the payment, correct? To pay to buy to pay for the same units of goods and services. So in this particular case, you can conduct hedging to reduce the risk. So how to conduct hedging? So here your strategy is to obtain a forward or futures contract to purchase foreign currency. Yeah, so in our text, let's say in our example, so Jim Logan, right? Jim Logan, in the case of Jim Logan, so yeah, so maybe he only engaged in pound sterling, so he have to purchase the pound sterling. Okay, so it depends on what kind of foreign currency that you need to make the payment. Okay, however, if you have another situations where you receive receivables, so when you sell, when you export your goods and services, so you expect to receive payment. So when you are expecting to receive payments, and at the same time, let's say through your forecast, you find that there will be an appreciation in domestic currency. So what will happen? So let's say like this. So the dollar appreciate against the pound sterling. So when this is the case, so that means when you convert foreign currency into domestic currency, so the amount that you receive will reduce, okay, when your domestic currency appreciates, correct? So this is a risk. The amount that you receive in domestic currency will reduce. So therefore, you must conduct hedging to minimize this kind of exposure. So what you can do? So you should obtain a forward or futures contract to sell foreign currency. So this is the right strategy that you should use in order to minimize the risk. Okay, so this is the case for forward and futures hedge. So beside using forward or futures contract, you may also consider money market hedge. Okay, so how we can use money market hedging strategy? So the same thing also, we are facing two types of situations. Payables, when you want to make payment, okay, when you make payment, and then when you expect a depreciation in domestic currency. So how we can use money market to conduct hedging? Yeah, your strategy is you need to borrow funds in the home currency. Why we borrow from home currency? Because home currency depreciates. Okay, home currency depreciate, and after you borrow the fund in home currency, so you make short-term investment in the foreign currency. Why we invest in foreign currency? Because foreign currency appreciate. You look at this case, foreign currency appreciate, domestic depreciate. Okay, so you borrow from a depreciated currency and you invest in an appreciated currency. So this is how we can conduct hedging on the payables. All right. So when you are expecting to receive payment, okay, and then you are expecting an appreciation in domestic currency. Okay, so now what currency should be borrowed and what currency should be invested? So again, we apply the same logic. So you should borrow funds in the foreign currency because of foreign currency depreciated, and then you invest in the domestic currency. Why? Because of domestic currency appreciated. Okay? Yeah, remember, in money market hedging strategy, you borrow money in depreciated currency, and then you invest the funds in appreciated currency. Okay, so you should understand this strategy. So you borrow from a depreciated currency, but you invest in an appreciated currency. So this is a strategy for money market hedge. So beside money market hedge, forward and futures contract, you may also consider currency options. Why we consider currency options? Because firms recognize that hedging strategies such as forward hedge and money market hedge can backfire when a payables currency depreciate or a receivable currency appreciate over the hedge period. In this situation, an unhedged strategy would likely outperform the forward hedge or money market hedge, and therefore the ideal hedge strategy would insulate the firm from negative exchange rate movement, but allow the firm to benefit from favorable exchange rate movement. Okay, so because of that, therefore, currency options exhibit these attributes. Why? Because a currency call options provide the owners the right to buy. Remember, can you still recall? A currency call option provide the owner the right to buy, and then a currency put options provides the right for the owner to sell a specified amount of a particular currency at a specific price, and the specific price is sometimes called strike price, exercise price, within a given period of time. Okay, so in a contract, you are given all types of currency, price, and also the time period. Okay, so here, again, we have to look at first, if you face this kind of situation, you are expecting to make payment, and you expect this to happen, depreciations in domestic currency. So what kind of strategy you should apply? You should obtain a call option on foreign currency. So you should in this case, you should buy the foreign currency. So you apply this option, call options, to buy foreign currency. And then if you want to hedge on receivable, you are expecting to receive payment and you expect this to happen appreciation in domestic currency. So the strategy would be obtain a put options on foreign currency. Okay, so these are the hedging strategies that you can apply. Okay, so these are the very common strategy, but you must know what kind of strategy is suitable for your payables or receivables. Okay, so in this video, I'm going to conclude these sections. So these are the key takeaways from this lecture. So we know that exchange rate movements can affect profitability, cash flow, and also the market value of multinational corporations. So therefore, multinational corporations must closely monitor their operations here to determine how they are exposed to various forms of exchange rate fluctuations. So of course, to closely monitor the operation, they must know how to forecast exchange rates. They must know how to measure foreign exchange exposure. So with these two information, then they are able to determine whether and how to protect their operation from that exposure. So they must manage the exposure. So how to manage? As I showed you just now, they can use forward or futures hedge, money market hedge, or call or put options hedge. Okay, so yeah, again, this diagram actually shows how we can complete the whole sections. So the foreign exchange risk management. Okay, so here we have covered two sections today, and this has been covered in our last lecture. Okay, so we have complete the whole sections, risk management sections. So in don't forget to answer all the quiz. So there are 5 questions for this first quiz. So please answer the quiz, and I wish you all the best.